TV18.
Well, the last 3 to 4 months have brought about unprecedented change. Change in the manner in which we live, the way we work, the way we meet each other. And as this pandemic has raged on and continues to rage on, it's also thrown up some very interesting trends. As the digital world becomes the new reality, as we learn to do things differently, Anuj, it seems to me that people are also thinking differently about their money and about their investing.
Oh yes, they are, Surabhi. And you know what? I always believe in this. You give a hungry man a fish and you feed him for the day. You teach him how to fish and he'll never go hungry again. So, you know, the basic genesis of this show, the investment guide, is that, you know, there's been a lot of equity cult in India. Now, it may be enforced, or you could argue that it's been there for the last 2-3 years, but there's been a lot of retail money which is coming into markets. And instead of just dismissing it as saying that that's speculative money, perhaps this is the money which is actually looking at long-term wealth creation. And you know, I've been doing YouTube lives, and one feedback that I constantly get is that don't give us stock tips. Tell us how to pick stocks. I think that for me is a very big change. And you know, that's the genesis of this show, where you know, people want to know how to pick stocks and how to stay with them or how to exit them. And this is something we'll find out.
Well, that is exactly why we are here this afternoon, because if you are new to the stock market, if you want your own wealth creation journey to start, if you want to know how to create your portfolio, then we are going to be your friends. Welcome to the CNBC TV18 Investment Guide. Okay, let's start with the big numbers, because numbers always tell a story. What are we talking about? What is this rise in retail participation? Let's map this out for you. Well, over the last couple of days, we've been on a fact-finding mission, and let's put the numbers up for us, starting first with cash market turnover, because that's where pretty much most of retail operates. Now, if you're looking at the retail component of the total daily average turnover, then the numbers have been rising. I mean, look at this. First quarter of FY20, we were closer to 19,000 crores on a daily basis. Now that number is almost touching 34,000 crores. If you do a percentage as the percentage of the total turnover, then once again, from the early 50s, we are up to 57% now as of first quarter FY21. So that's the first data point to perhaps keep in mind. We went out to talk to brokerages to try and understand if this is really showing up in new account openings. Guess what? It is in a very big manner. This is Zerodha, one of the largest online brokers of the country, in fact, the largest perhaps. And look at the numbers. I mean, 128%, 255, 187%. 244%. This is the increase in the monthly new account openings to the pre-COVID normal, which Zerodha had in mind. What they also told us, by the way, that these new accounts are being opened all around the country. It's not just cities like Mumbai or maybe Delhi, but look at that. Hyderabad, Surat, Bengaluru, Nasik, Ahmedabad. Investors are coming in from everywhere. I want to move to one more brokerage just to put the stats in place. Now, at Motilal Oswal, this same trend is apparent when you're talking about retail participation. For them, the new account openings in the retail category were up 247% in the fourth quarter. They continue to rise 166% in the first quarter of the current year as well. And again, if you look at the volumes, if you look at turnover at Motilal, it's going to tell you the same picture. 51% rise in the retail, daily average volume on the first quarter number, the first quarter of FY21. I then chatted up with people at Axis Securities to try and see what they're saying. Their feedback was actually very heartening, and they told us exactly what Anuj was mentioning, that these are not people who want to punt on penny stocks. These are not people who are looking at, stock tips or the odd, small cap here and there. They want to create portfolios, and this is how they're illustrating that point. In fact, this is again a quick take from Motilal Oswal about the non-institutional participation. 68% was the month of June. That's the figure. Now, when we move to the Axis data points, that's what I'm talking about. That this is not about penny stocks, this is not about speculation. The next plate is going to tell us that the delivery volumes are on the rise, and that's a very heartening point. You're not just buying and selling on an intraday basis, you're taking delivery of the stocks. And look at this, 25% to 40%. That's the rise in delivery volume for them, for their retail brokerage operations over the last 8 months. So very, very heartening. So what is it all boiling down to, and why is this happening? This is a question we ask all the market participants. And I think the sum and substance of it is this. Yes, people have had more time as work from home became a reality. You have brokerages now offering, almost zero brokerage. So digital is a big medium. That's the way a lot of the young population is transacting. So it's getting people very excited. But I also think that perhaps it has something to do with the fact that mutual funds have had subpar performance in the last couple of years. People have really waited for a long time. And maybe now they think they want to also start their own investment journey, try and see if they can build their own portfolio. So some interesting trends there, Anuj, that I spotted in the numbers.
Yes, Surabhi, and like with most things in life, the answer would be somewhere in between. I think it's never a case of either or. You should always have a mix of mutual funds and direct investment. Well, since you spoke about numbers, let me also give you some numbers. And this is about the state of the market right now and with this retail participation. Now, what has rallied since the March lows? It's been a secular run. It's, you can't say that the market's been narrow or the market's been too focused on the mid caps. Just look at these numbers. They'll come up for you. The Nifty has rallied about 48%. The Nifty mid cap 43%, the Nifty junior 44%, and the Nifty small cap about 54%. From the March lows, that's the kind of rally we have had. Now, you could argue that the small cap has risen a bit more, but the next bit would tell you that that perhaps is not entirely the case, because if you look at the distance that these indices have to travel to get back to their peak, Nifty has moved within 10%. The mid cap is within 16%. Nifty Junior, which I reckon is the best index that we have in this country in terms of good companies, that's 9% off, and the small cap index is 23% off. Also, what's interesting is what has rallied. I've looked at the F&O stocks. Of course, there have been some penny stocks which have risen, but that's been the case globally, and that happens all the time. One constant theme is this hope trade of post-COVID world, the reopening, and the pent-up demand coming back. M&M. Reliance, IndusInd Bank. Reliance, of course, is more of a telecom play now. IndusInd Bank, Hero MotoCorp. If you look at the other stocks as well. Now, you could argue here or there about stocks like Vodafone Idea or Indiabulls Housing, but that's also the kind of hope trade which has played out. Aurobindo Pharma, Escorts, and Muthoot. The reason I'm trying to say is that the rally has still been reasonably healthy. And just one last point, the market returns or the market numbers always have to be looked at in context of valuations. Now, on the Nifty, what was interesting was that we went to the peak price earnings, and I look at the trailing numbers of 29.9 times, which fell to 17.2 times in March. Now we're back to 26 times. The mid-cap index, which is where the bubble was in 2017. 2017 was the bubble, 2017-18. We went to as high as 62 times. Then we fell to 16 times in the March lows, which is where a lot of value buying was there. We've risen to about 24 times. Earlier we spoke to Ridham Desai. He said price to book is a better way to look at these things. So I looked at price to book as well. Again, on the Nifty, from 3.86, which was the peak, we went to 2.17. We're now at more reasonable 2.94. And on the mid-cap side, from 3.28 to 1.59. And now we are at 2. So, well, that's enough of numbers. Let's now invite our big guest. Raamdeo Agrawal is joining us, co-founder of Motilal Oswal Financial Services, and someone who, of course, invests his own money in stock markets. All of it is, in fact, in their own fund. Raamdeo, thanks a lot for joining us. It's always good to talk to you. I wish we could have done this in studio, but of course, this is a new normal. So, you tell us, this retail cult, people asking how to pick stocks instead of asking for stock tips. Does that enthuse you? And what's your overall take on the kind of participation that we have seen in the markets?
Yeah. So, Anuj, it has been a pleasure to talk to you on this subject, because this has been my passion for last 35 years, and it has been a all the way learning journey, and still we are a student. You are never done in terms of how to pick stocks ever. I mean, you are learning all the time, and so the as far as coming back to what you talked about the recent trends. So I think we were seeing the pickup in the volumes for last 2-3 months, but June was particularly a big blowout, and I think just the start of the June, April, May was good, but June was in a different level. So it has gone and it has become hyper, and probably July is also continuing with June. So I don't know what is the reason for it, but maybe it is a home lock people. They are taking a lot of interest in participating in the market, and all dematted kind of situation, zero zero fraction account opening and the trade is making people participate, and it's a very exciting time. Market had corrected all the way to 16-17 P multiple, and this happens once in a decade kind of situation. And from there, market has rallied, as you said, 40-50%. And that exciting journey, people want to repeat and they want to participate going forward. So that's been and it's not an Indian trend, it is global trend. I think in US, the brokerage firms, online sites have been breaking down. So much of volume is there. So it is something to do with the liquidity, something to do with the cost of liquidity, disappointment with the fund manager's performance. All sorts of things are there. But right now, the party's on. That much I can say from the participation by retail investors are concerned.
Raamdeo, always such a pleasure to have you. And by the way, I must wish you as well. I believe it's the 33rd Founders Day at Motilal Oswal. Is that right?
Yes.
Okay.
Yeah, so this is 33rd. This is 33 years of stock picking.
Okay, I think this is a brilliant coincidence then you're the right person to join us on this journey, because our whole endeavor here is that while it's very easy to come to the market, it's perhaps a little more difficult to make money and make sure you don't get burned. So I'll start with a very basic question, Raamdeo. Is it really for everyone? I mean, we all feel we can be trigger happy, we want to go out there, pick our own stocks, but I don't know, what is the first fundamental question I should ask myself before going into direct equities?
Yes, I mean, you can say that it doesn't require any qualification, but it requires a lot of common sense. I mean, if you are willing to, use your common sense, because yes, you need to be a chartered accountant, you need to be a commerce graduate to understand the language of commerce. But common sense also tells you whether a company, what is the worth of a company. So if you are able to assess by using your common sense, what is the worth of a company approximately, and you don't have to know all the companies' worth. You need to know a few companies' worth, and with the help of internet and all, you can catch up with the reading very quickly. So if you are willing to read, if you are willing to learn, you are willing to try, and also see some small accidents on the way, but you are determined to make it in the stock market, you don't require any big degree or particular kind of degree to start up in the stock market. You need a lot of common sense, perseverance, and a lot of hard work also.
Yeah, some of the best investors or traders I know perhaps haven't got that professional qualification. So I think you've hit the nail on the head. Raamdeo, a lot of people ask this question that, it's also about psychology. How do I decide if my, trading, if my psychology is for trading or for investing? If my patience is for trading or investing, what suits me more? Because there are people who have been successful traders and investors both, but what is the distinction that you would make between a trader and an investor?
Yeah, so that's the main thing to understand. When I'm interested only in the price performance, and that too in a short while, clearly that is the definition of a trader or a speculator, I would say. Nobody likes to be called a speculator. But who's the investor? Investor is the person who's interested in safety of the money which he has put in the market and a decent return. Safety of the capital, what he has put in, and a decent return. Once this is there, that qualifies for being called investor. And speculator is the one who doesn't care what he's buying. He's interested only in change the stock price. He's buying something at 100. He doesn't care what he's buying, but the moment it goes to 110 or 120 or even 150, he dumps it in the market. Even if he takes delivery of the stock, if the style is this, the momentum or just the price change, I think he will be classified as a speculator. That's how simply one tries to figure out. And I would say, any person who is trying to get into the market, he must decide how much patience he has, because being an investor, you need a lot of patience. And being a speculator, in fact, the absence of patience actually makes you a speculator, because you want price action very quickly in the marketplace, and then you want to make quick buck and run away. That is a speculator's characteristic. Whereas the investor says, okay, I'm buying this company which is earning 100 crores today, and in 5 years' time it is going to earn 200 crores, and hence the price of the stock may double or triple. And when that happens, then I will. That's how I'm going to benefit. I will triple my money in 3 years, which is compounded 25%. That's how I want to make money. But it requires staying with the stock for 5 years. That is the investor's attitude. And the first one, he also wants tripling of the stock, but he doesn't care what is happening with the company. So I hope I'm trying. So you need to figure out what's your attitude towards the stock market or stock prices.
Yeah, I guess, and Raamdeo, the problem comes when the investor starts suddenly mid-course becoming the trader, or when the trader stops respecting stop losses and then suddenly wants to become investor if their trades are not going right? That's where the problem comes. But another basic question, and I guess this is something which a lot of people now might have on their mind. This has been a fantastic rally, Raamdeo, where every macro indicator is down, GDP is down. All these numbers are lower, but stock prices keep going higher and they keep going higher and higher. So what do you say to first-time investors who are witnessing this phenomena? Can there be a prolonged disconnect between the way stock prices move and the way the GDP or macro indicators move?
As far as short-term stock price movements are concerned, I mean, nobody knows with any confidence what is going to happen. But if the crowd build-up keeps happening, if the amount of money which is pouring into the market keeps growing up, if the money which is poured into the market keeps going up, clearly market momentum will be on. There will a lot more trades will keep happening, and there will be a lot of excitement in the marketplace till more and more money keeps coming. But someday, I mean, I don't know how far that day is, when the money stops flowing in the market, then suddenly you see the vertical downdraft in the marketplace.
Okay. Raamdeo, stay on. We need to take a break. Up next, we'll discuss one of your favorite topics, growth versus value. And we are getting a lot of queries from our viewers. So we'll take some of those queries in our next segment. We've just started. Don't go anywhere.
Nine to 5 job, अरे 5 to 9 job, भाग दौड़ all the time job. The roaming wala job, the deadline wala job, or are you living in the market wala job?
Life is full of options. Choose a job and earn on your own terms. Choose to become an LIC agent. It's more than a job. It's career insurance. Be your own boss. Be an LIC agent. Ab life set hai.
नहीं AMT है, winner gets to drive.
ओए, ये cheater रुक!
Now with AMT, Renault Triber, space for everything. Renault, passion for life.
Welcome back. We are on the investment guide talking to one of India's best-known investors, Raamdeo Agrawal. Raamdeo, now, let's talk about some important topics. And I'll give you an example. Raamdeo, you invested in Hero Honda. Then it was Hero Honda, of course. And you reached a point where the dividend income every year was 5 or 6x of your original investment. Now, how do you decide? You own the business, right? How do you decide this is the business that I want to own, and this is going to create wealth for me? What's the decision process? Explain to us.
Yeah. So now in last 25 years, I mean, this I did in 96, but in last say about 25 years, we have coded the entire process as QGLP, quality, growth, longevity at reasonable price. So, when I look at a stock, I mean, the process remains same even today as it was in 95. So, when you come across a quality business, high quality business, see, one fundamental thing to understand is there are two types of business: good business and bad business. And the businesses can be so good, you cannot believe it can be just a free cash flow machine, and the business can be so bad, it can be just a dumping ground of the capital. So there are two contrasts in the businesses. You have to understand fundamentally, the moment you look at the business, any company idea comes or any thought process comes, first you have to figure out whether you are looking at a good business or bad business. Only the good businesses compound in the long term. Making money in the stock market is all about compounding. So you have to find a business or business opportunity which is not only good, but which has a compounding capability in the future. So that is one potential you are buying into. And that is before even you have started the research, first flash should be to figure out whether the business is very good and it has a long-term potential, positive potential outlook. So if something is making 100 crores, you must figure out whether it has a potential to make multiple, 25, 30, 100 times or 1,000 times of the current profits this business has the potential to make. So once, whether it will make or not, that only time will tell. But whether the potential is there or not. So that's one thing. Second is the quality of management, which is most important, because even a good business run by bad management, so 1 multiplied by 0 is equal to 0. So what you have to say is whether the management is competent or not. And so in India, you get a lot of competent management, because if the management is not competent, company is not going to make money. So you need top quality business, you need top quality management. And what are the qualities you are looking for in management? Terrific competence and good value system, terrific value system. And third, a growth passion. You know, the guys who are wanting to make it big in life. I mean, once a company starts making 100 crores or 150 crores, then a lot of managements, they take a slow lane, or they don't want to grow, they don't want to compete. So those kind of managements cannot go far, because everywhere there will be competition, there will be a lot of challenges, but growth mindset allows you to go multiple X from wherever you are. So terrific business run by terrific management with terrific potential, this itself allows you to make a lot of money. You will make money. Now, once you have the quality business run by quality management, 99% job is done. Then once your value pack is seen, this is a value pack, then you look at the price. I mean, this particular business which you are buying today, which you have decided to buy, you said, yes, both the boxes are checked in, good business, good management. Now let me look at the price, because investing is all about at what price you buy. Your purchase price will decide your rate of return. And hence, you have to look at the valuation. And that's where a bit of technicality comes in, whether you are paying too much. Because the margin of safety between the price and the value is very important. Nobody wants to do the hard work of estimating the value. Everybody looks at the price. Anybody looking at the price has no advantage in looking at the price. The real advantage is trying to understand the value.
Sure.
That is an art form, to estimate the value of a company. Once you think that this company, which is making today 100 crores, and it can make about 1,000 crores in next, say, 10 years, 25% compounded, and the current P multiple is, say, 15, and if the terminal P multiple is also going to be 15, you are sitting on a possibility of making 25% compounded for next 10 years, which is a 10-bagger. And that's how you decide, okay, let me get in.
Okay.
You know, that's how I thought when I looked at Hero Honda. There were many other things and understanding the company, but that, I mean, when you get to nitty-gritty of understanding a business,
yes,
you get into that. But it was a fantastic business on the day one.
Okay, that's the entry point. We're getting a question, Raamdeo, from Krishnadan, that, okay, entry is fine, but is it important for an investor to churn the portfolio at regular levels or just stay put? And how do you decide that? That's also important.
See, what is important is to buy right. You know, you have to buy something which is worth 100 rupees at 30, 40, 50 rupees. That is most important. And as the journey starts and you have made 5 times, 10 times, 20 times, it doesn't really matter. I mean, you didn't sell it at top. I mean, I remember when I bought Bharti Airtel in 2003 at 25 bucks. It went to 1200, and then for some reason I couldn't sell at that price, that point of time. I sold it at more like, say, 650 or 650 rupees. So still it was 25, 30 times, which is good enough. So you don't have to focus on churning and all those. That is not the investor attitude. This. Before you're bought, you're thinking about churning and all. This is not the investor attitude. This is more like a speculator attitude. So you have to be very careful where you are focusing as an investor. You have to focus on investing on the right company at right price at right time. That is more important than trying to figure out whether I should churn or this or that. That is much later. Even if you do a bad job of selling, you'll do a wonderful job of investing.
Okay. Now, Raamdeo, actually, on one hand, there is this investor who was asking about churning. On the other hand, there's one more query coming in. Let's see if we can pull that up. This one is from Suresh Ramamurthy. and he is asking you, saying, "Dear Raamdeo, can you please define long term? Many stocks that I bought are now at 10-year lows and have approached my cost price. If I had sold at the high, I could have re-entered at lower levels. I would have made some money." So I think, this is the other thing, Raamdeo. What is your definition of long term? And should it be different in different market contexts or different economic contexts? Do you need to keep re-looking at that stock? Or is it just buy and then just hold?
No, I mean, see, the point is, if you have bought it right and you have bought the good company, growing company at a reasonable price, generally, in the very first day, you should make money. I mean, you have to really question whether why you are not making money. Are your assumptions right? What you thought about the company's story about how it is going to develop, whether it is developing right or not. It's not about the price. See, if you are looking only at price, you are ignorant about what's the underlying business is. You should be able to make the first most important thing in investing is whether you understand the business or the company or not. That is 99% of investing. If you don't understand what you're buying, I mean, what is the underlying thing? Is it gold? Is it silver? Is it diamond? That you must know. And if the moment you know that this is what I bought and the story has gone wrong, your assumptions have gone wrong, because it's all about the future. You're buying the future. If that assumption has gone wrong, you yourself know that things have gone wrong. Whether it has gone wrong in 6 months or 3 years or 5 years, you have to figure out. I don't think you must blame the long term or short term for non-performance of the stock. I mean, stocks are all types. Some stocks are multi-baggers, some stocks are steady performers, some stocks are going just straight from 0 to 0. So you have to be in the control of your destiny, and that control of destiny comes from your understanding of what you have bought.
Okay, well, points taken, and I'm sure our viewers and all the new investors out there are taking due notes. We do need to take another very, very quick break. The conversation is going to continue, and we put more of your questions to Raamdeo in just a moment.
किट्टू भी मेरे बेटे जैसे ही है। सुनील जी, मेरी मानो किट्टू को ना सिविल इंजीनियर बनाओ। याद है बचपन में कभी दीवार पे पत्थर, कभी फर्श पे हथौड़ा, और पानी का पंप तो कितनी बार बंद किया उसने। अपने भाटिया जी के कॉलेज में किट्टू की सिविल की सीट पक्की, बाकी आप मेरे पे छोड़ दो। हेलो।
free career tips देना तो इंडिया का unofficial national sport है.
But you don't need to participate. Discover what's best for you at Vijay Bhumi University, India's first liberal professional university. It's a unique university.
घर में फैमिली की डिमांड्स और ऑफिस में काम की इन्वेस्टमेंट करने के लिए टाइम कहाँ मिलता है? मिलता है क्योंकि मेरे पीछे SMC है. SMC, money wise, be wise.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.
A rapidly changing political and commercial environment has presented the world with opportunities for economic transformation. Bringing together leaders in government, business and society from across India and the United States to set the post-pandemic recovery agenda. USIBC India Ideas Summit this July. Exclusive media partner CNBC TV18.
Welcome back here with the first edition of the CNBC TV18 Investment Guide. And our guest on the show is someone who's seen so many market cycles, Raamdeo Agrawal of Motilal Oswal. Raamdeo, now we want to spend some time talking about quality, which is one of the key filters that you always talk about. And it's exactly what you were just saying, right? If you pick the right stock, then you're home. So how do you define quality and what are the parameters that you strictly measure quality against?
This is one subject of quality, which everybody knows what is quality, what is not quality, commonsensically. Yet there is no defined way to say that this is one way to see the quality. But I mean, there are 5-6 ways one looks at it depending on the company which you are looking at right now. But one common filter which comes to my mind to start with is about the return on equity or productivity of the capital, and for how long the productivity of capital is high, and is it a company which has a sustainable business and a business which has a high productivity of assets or capital, you can say. Say you have 1,000 crore worth of asset. Some businesses, they barely earn, say, 100 crores. That's about 10%. And some business, year after year, they earn 250 or 300 crores, 25-30%. That's where the quality story starts. And understanding quality, again, has a two dimension. One, are you looking at old company, something which is running for 10-20 years? Or are you looking at a company which is a brand new company, which is just 3, 4, 5 years old or 7 years old, first time they're making profit? So if you looking at old company, I mean, most of the time, 90% time you're looking at old company with track record of 10, 15, 20 years, you get nice, ratios where you can figure out right from now I'm really remembering the process, how I go about it. I go to my ratio. I mean, once I see that companies of reasonable size making 10, 20 crores, then I go to straight ratios. Because when you're doing ratios, you typically don't see the absolute number. So when you look at the ratio, the first ratio I see is what has been the recent track record of 10 years of the return on equity. And if turns out to be more like a 20, 22%, 23% year after year, with no break below 15%, the consistently, if it is making 18, 20, 25, 30 or even more, that's the kind of thing which brings the quality story on. Because one of the belief is that businesses are capital input-output machine. Irrespective of name of the business, businesses are capital input-output machine. And if the risk-free rate is about 8 to 10%, then significantly higher return on capital or assets is a sign that there's some magic on in that particular company. What is that magic? We don't know, but the numbers are telling me that they're able to earn a lot more on the capital employed than the normally what a business should be earning. So that is the first starting point of quality company. Then you look at that is the first ratio. Then you look at the terms of trade. Immediately I go to the terms of trade. If the company is making money, then are they able to collect their money, collect their dues? Like if you are giving, you'll find very few companies with less than 30 days debtors level. So what happens is, if you do business, you make the things in 30, 40 days, 50 days, depending on what you're making. and you are giving it to your customer or dealer or distributor, and you are not able to collect the money, or are you able to collect the money in 10 days, 15 days, or on a spot? There are 2-3 types of business. One, you collect it after 30 days. Other, you collect it on cash. And there are some businesses where actually you collect it before time. That is in advance. That shows the strength of your business. So we are not only earning 20% or 25%, you are also able to collect the entire profit well on time. That gives you cash flow. And so once you have the high ROE and very good terms of trade with your buyer of the products or services, that kind of starts my inquisition about what exactly is this company and how good they are designed. And then you get into trying to understand the businesses, what are the entry barriers. Then you try to figure out the entry barriers. Like, is this company very unique in character? Because there can be two ways of uniqueness. One is the completely differentiated company. Nobody else can do it. Or second is that it is the lowest cost producer in a commodity kind of business. You're in cement, you are in steel, you are in pipes, but you are the lowest cost. Okay. And third is what kind of market dominance you are in terms of market share. So differentiation, low cost, and the scale. And if all three come together, like Maggi Noodles, it is the largest noodle company, it is the lowest cost, and it has the largest volume. So when all three entry barriers come, then you know that this business can last for a very long time.
Okay.
And so various aspects of understanding quality, it starts going into that. And then you start asking, once your business, you are very happy with cash flow, and then you look at the growth. And if the company is growing or has a potential to grow, and you are satisfied that, yes, this company can be 5 to 10x in next 10 years, and that satisfied your kind of requirement, then you go to look at the management. Well, who is going to execute this and what is their track record? So, the quality is made up of good quality business and good quality management. And we discussed earlier about the 3 traits of good management, the competence, passion, and growth mindset. When all 3 are there, and you like when you talk to the management, you like his passion and his energy, his competence, his understanding the business. He adds a lot of value to you in telling you about the business. And then you keep seeing whether those matrices which you have seen about the businesses, about the ROE, growth, cash flow, all of them are going to be building up along with the management commentary. I think that's how you start trying to build trying to understand the business, what it can happen in next 10 to 15 years. Because you have to build cash flow model in your mind about the next 10 years. Typically, I do for 10 years. In those 10 years, you look at the compounded. Now, what happens is in quality businesses, you compound your earnings, say, by at 25% in 10 years. Now, in 10 years, the company will earn total profit in next 10 years. If you add up all the profits of all the years on a compounded basis, typically a company which grows at the rate of 25%, it will earn 42 times of the year 1 profit. Total profit earned in next 10 years will be 42 times. Wow. So if I'm getting this company at significant discount, say 15p, 10p, 12p, 17p, market doesn't do so much of calculation. And at times when the story is young and new and unknown, you get the stocks at 12, 13, 15, 16 times. And that's where you need to strike your purchase decisions.
Okay.
So, I've told you how exactly I do it. And it depends on the company and the business and how complex is the business. And at some point of time, you realize that it is not your cup of tea. You're not able to understand what management is saying and what the business is. Then you give up. But mostly what I see in the ratios, when I talk to the management, I'm able to connect.
Okay, and your passion shows, Raamdeo, with the way you answered that question. Now, Raamdeo, since you spoke about 10 years, and fascinating, by the way, 42x in 10 years. Now, I'm going to ask you a hypothetical question because this is the next topic that I want to discuss with you. Suppose you were in the US and you were holding Tesla. Now, what do you tell yourself? Is this a bubble? Or is this something where I got in and I just want to carry? I mean, how do you differentiate? So the holding period for such stocks and whether it's a bubble or not, how do you decide in a market?
I don't know how you picked up Tesla, but Tesla is my passion and I have kept in one of my trackers. I keep saying, I discuss Tesla every day. Now, Tesla is a very unique company in the sense that, in fact, I held a 1 hour conference call with the one of the analysts in US about trying to understand Tesla. So Tesla is a very unique company. It is the one of the ultimate example of value migration, where the entire car industry, current IC engine car industry, is transiting from current old technology, 70, 80, 100 years old technology, to a new technology called electric car engines. So, and they are almost monopolist in the sense that there is a company in China called BYD, but they are very low end. Whereas the Tesla is way ahead of any car company in terms of electrification of cars. So it's a very unique company, very passionate company, and the concept is very powerful, and they've just become profitable. I think in 2019, they made about $200 million profit. And I saw the projections of one of the famous analysts, and he's saying in next 3 years out, the company could be making $4 billion of profit. I don't think there's so much of significance in the the numbers, but what is important is to understand the competence of the management to do this transition. I mean, it is world's one of the most talked about or industrial innovation, which is on right now. And no more it is a lab. Now they're producing about 500,000 cars every day, every year. So I would think that it is a very highly potential company. I don't know how to value it in the sense that the markets are in a frenzy right now at about $1,500-$1,600. It is $300 billion. It is tough for me. At about $500-$600, I was quite convinced. And I was thinking that it's a good bet to have. In fact, I was thinking of having some portion in my portfolio, but it is so violent and it moves so fast that I couldn't gather courage. But it's not a bubble. I mean, right now the valuation might be in bubble zone, but the company is not a bubble.
So how do differentiate that? In Indian context, for example, when do you say, okay, this is clearly a bubble?
I mean, anything which you don't understand and you cannot, rationalize the valuation, that's a bubble for you. And bubble can be different for, what I don't understand, I would think it's bubble, but the guy who understands, for him, it may be just a real thing. I mean, as I told you about Tesla, at $300 billion, with my limited understanding and knowledge sitting here, I think it is in bubble valuation. Company is not bubble, but the valuation is bubble. But the person who understands, the analyst who understands, and he knows the corporate plan, that he is going to go from $500,000 to $2 million in next 5 years, I think it's a very fair valuation. It could be $1 trillion company.
Since we're on the subject of valuation, this is so close to a lot of people's hearts. Raamdeo, to determine valuation and to determine whether something is just way too expensive, what are the ratios or what are the key fundamental metrics that you apply, the kind of ratios that you like the most?
Yeah, I'll tell you what I do, because this is all in the realm of understanding. But I would say that I look at the earnings and earnings growth. Earnings, quality of earnings, and earnings growth, and longevity of the earnings. So if, as I said, if I see earnings today at 100 crores and it is likely to grow at 25% for next 10 years, I'm pretty comfortable buying up to, say, 35, 40p multiple. Because I know the total money made in next 10 years will be 42x of the current profits. So in fact, my typical buy zone is up to 25p. Anywhere, one peg is my buy zone, half peg is a multi-bagger. And after that, you start paying 50p. Your return will be more like 12, 15%, 17%. And there's a chance that in between you may lose money. But if you pay 75 or 100p, then you are in a speculative zone. And then, I mean, anything beyond 3 peg is a complete no-no, irrespective of, even if 100% is free cash flow. I would think that, I would avoid that kind of company.
Okay, let's take a final break. Raamdeo, once we come back, we have 2-3 more queries for you from our viewers. We'll take those after the break.
A monk who trades, an MCX IPF initiative. Please do not put your phone inside your helmet.
I will talk on the way. Saves time.
Fine.
Stop. Can I see the citizen's face?
See, sir, I am wearing helmet. Law-abiding citizen.
Not helmet, but helmet!
Oh, my new phone.
Respect the law, and it will respect you back. Do not indulge in unauthorized trading activities, which are both risky and illegal.
Space. There are times when we all need it.
How's your day?
Great. Sometimes you need space to be alone with your thoughts. If only others would let you. And only by taking time to lean into ourselves can we truly get close to each other. Hello, MG. How was your day?
Great. How is it going with you?
It's a human thing.
The all-new 6-seater MG Hector Plus. It's a human thing.
I wake up believing it's gonna be a great day. Staying fit is something I strive for. The best part about work from home is breakfast with my wife. My son Nee, he rewards me with a kiss which I cherish the most. It's time to get the final touches done as we're almost at the business end of my morning. We're all set to roll. But on a daily basis, my first guest is someone who commands his chair but often jumbles up my numbers. My son Nee.
Welcome back. Well, we are in conversation with Raamdeo Agrawal. Raamdeo, a lot of people asking that, okay, past multi-baggers are history. What's the next multi-bagger, right? In the current market situation, what should you look at to identify the next 5 or 10x bagger? Any thoughts?
I mean, Anuj, it is so difficult to say today. If I was knowing that this is going to be multi-bagger, I would put 90% of my net worth out there. But it is the nature of the stuff. I mean, I have seen this this correction taught us a lot of things. One of the things is that highest conviction stock corrected maximum. Now, where is the question of saying that this stock will be multi-bagger? So when you put a bet on the companies, typically you start with 3-4% of the portfolio. I start typically with 2.5-3% of the portfolio. And then once you are into the stock, then you start realizing that the stock is better than what you thought. And then many times what happens is the multi-bagger happens, one, because of the earnings growth, and you have been able to buy very cheap. I mean, what I said, the formula for multi-bagger, if you are able to buy a stock with 25% growth at 12-15 PE, and if the actually growth delivers in next 5-6 years, you are bound to sit on a multi-bagger. And it also depends what is the multi-bagger. I would say anything which is 10x in 5 years, 6 years, or even 10 years is a multi-bagger.
Okay.
I mean, today it is, every stock we buy, in the portfolio of 20-25 stocks, almost all of them, at least 50-60% of them, have the potential to be a multi-bagger. Many times multi-bagger is not because what you thought. Many times multi-bagger is because of the external environment. Because what happens is you think that something is going to happen, but something happens which is far better than what you ever thought. Like you might be seeing today in COVID, because of the COVID, the importance of technology or some of the companies or adoption of online. I mean, people were struggling for many years for people to adopt the online sales. And suddenly you realize that they are growing by 200%, 300%. That you never thought 3 years back. But today it is happening. What didn't happen in 3 years has happened in 3 months. So, a lot of multi-bagging happens because of even external, tailwind, I would say. Tailwinds and even euphoria of the investors. Like I remember in Hero Honda, we had a wonderful journey between 96 and 2003 or 2004. I stayed till 2014 in first round. But the stock never went beyond 15-17 P multiple. The earnings growth were 25, 30, 35, 40%. But the stock never took the fancy of the market and never became very expensive. So, it all depends on your luck also at times. Multi-bagging has a lot of role of the tailwind, a lot of role of the, external environment becoming very conducive in terms of P multiple. and of course the performance of the company. Bedrock is the performance of the company. Now, if I'm not supposed to discuss any specific stock. That's my job. I keep finding things we have put in our portfolios, and they are supposed to be, some of them are clearly supposed to be multi-baggers, because particularly in the mid-cap segment, some of the companies have come to a level, particularly in the last 2 months, that there is a potential to be mini multi-baggers, if not a huge multi-baggers in next 3-4 years. So yes, but I'm not at liberty to talk so much in detail about a particular company.
Sure. That's not the mandate over here on this show, at least, Raamdeo. But, I do want to ask you this. As you said, over 3 decades, you've been in the market picking stocks. You've seen multiple cycles, scams, the global financial crisis, and now this pandemic. Is there anything different about this cycle, this extent of global economic disruption? Do you think it's going to change stock picking or portfolios in any meaningful manner?
No, I don't think investing style is going to change. A lot of new opportunities will come up for sure. The opportunities which were not there, they will come up. And some of the things which are looking very good, they might also, some businesses which are looking far better than what they were, they will also to expose, particularly the ones which are leveraged, say banks or NBFCs and many other businesses which were very leveraged, and they were looking absolutely invincible in their kind of growth story and things like that. I think there will be a lot of rethinking in the market about them. So that is the past winners. Now, the same, this pandemic will give birth to new business models, new winners, new multi-baggers, and with a new vigor. Because the economy is going to come back maybe in 21, 22 or 22, 23 with a lot more energy.
Okay.
But where the energy will be shown, and then the government is also going to change a lot of rules. There will be a lot of liberation. One of the presentation I was making just last week was don't bet against India, because last 35, 40 years, I have seen this market going 100x. Next 30, 35 years looks as promising. Now the opportunities keep coming. If you have a prepared mind, the issue is that do you have a framework of picking stocks? The stocks will walk into your framework, I'm telling you. If you are clear about what you're looking for, whatever you get to see, you have to keep saying no, and then finally in 2 months, 3 months, 6 months time, you'll keep getting ideas. And when that idea comes to you, back up the truck and buy as much as you can buy. So it is all about the prepared mind, your frameworks, your eagerness to look at new ideas, turn as many stones as you can, and you'll find your gems.
Okay, Raamdeo, thank you so much. It's always a pleasure to talk to you, whether it's talking about the market, on the day-to-day market, or the investing, or the Unplugged show that we did with you. It's always good talking to you. Thanks a lot for giving us so much wealth of information, and I'm sure a lot of our viewers would have benefited from that, Surabhi.
Absolutely. Well, so that brings us to the end of the first edition of the CNBC TV18 Investment Guide. But keep watching out for us and watch out for this space, because over the course of the coming weeks, we want to interact more with you and take up more very specific thematic issues that you can use as you go about building your portfolios.